All right, we're going to lower expectations just a bit, but you can still get positive return in the municipal bond market. We want to bring in Peter Hayes. He's head of BlackRock's Municipal Bonds Group to talk about this. Peter, it's always good to have you here. And last time you joined us, we talked about the difference between traditional tax-exempt muni bonds and then the taxable bonds. Before we jump back into that, because I have a follow-up, you point out in your most recent note that in 2020, the municipal bond index, the S&P Municipal Bond Index, had a gain of about almost 5%. You think those gains will still come this year, but they will be moderated. What do those returns look like if they're moderated?
So it's interesting. We wrote that a few weeks ago, and now when you take a look at where returns are, the index is up about 77 basis points. So if you think, we think most of the returns this year are really going to come more from income, from carry or the coupon, as we like to say. There's more of that in high yield, so we think high yield will actually outperform and be a better place to be for a good part of this year, particularly if the U.S. economy rebounds. A lot of the sectors in municipal high yield were the hardest hit last year, and we think they may be some of the biggest to rebound this year. So, well, I think our expectation generally, despite the fact we're already up 77 basis points in investment grade and 2.4% in high yield, we do think that probably investment grade returns somewhere in the we'll call it 3.5% range when all is said and done. So we seem a little bit ahead of ourselves. We've gotten an awful lot of performance so far in the first 6 weeks of this year.
So, Peter, then if you were an investor right now looking at the muni bond market, you highlighted what you think is going to outperform. But the fact that we are a little bit ahead of ourselves within the first 6 weeks, how do you suggest investors then position themselves right now?
Yeah, that's the question. And it came up on our strategy call today, in fact. And it's sort of there's a couple of different things at work here. One is that new issue supply is low. Demand is still high. So the technical picture says, all right, those positive returns should continue for the foreseeable future until we begin to see a real buildup in the new issue calendar, which might be well into the end of March or April. So we have some time ahead of us. But at the same time, in order to build a defensive position in munis, you need to take advantage of liquidity while it's good, and liquidity is very good right now. So we're beginning to look at sectors that have outperformed, and we're beginning to pare back on the margin, and that's kind of how we're getting defensive. So for individual investors, I would have them take a look at their risk profile. How much risk do they want to take? Perhaps they own more high yield than they normally would, and maybe they want to pare back in that sector since it's done so well and go up in quality. Perhaps they own more duration than they would normally own, given the fact that most of the fund flows this year have actually gone into the long-term sector of the market, and maybe they want to move down to a short and intermediate. Yes, they'll give up a little bit of yield, but if there's a little bit of a hiccup in the market, they'll also be a bit defensive and save some of that principal.
Peter, I want to get to that tax question we talked about last time. And you're saying that about 30% of municipal issuance this year will be the taxable muni bonds. But there's an expectation the Biden administration will change the law which brought about the increase in these taxable bonds to make the I don't want to get into the weeds of the tax law, but most people, it's still 70% is still the tax exempt bonds. Why do you think the reissuance and the tax law are going to change under Biden?
We have what most people thought was not going to come to pass, and that's an all Democratic government. So in that likelihood, we tend to see taxes go up. Now, it's likely that I think the taxes are more likely to go up for corporations than individuals, but there's also components within the tax law. And you're right, the 2017 Tax Act actually eliminated advance refundings. And without getting into the weeds, suffice to say what that did, it created an arbitrage, effectively an opportunity for issuers to issue more taxable municipal debt, meaning the income is not tax-free like it is in the traditional part of the market, but they were able to refund outstanding debt by issuing more taxable bonds. And unless we really change and flip that 2017 tax law and once again allow advance refundings, it's likely the taxable municipal issuance will continue. Now, given that, one of the key components here is revenue. If they're able to try to pass the advance refunding and bring that back, how are you going to raise the revenue for that, particularly at a time when they're talking about an enormous stimulus? You have sort of this standoff, if you will, in Congress around how we're going to pay for this enormous stimulus package, et cetera. So I think it's going to be a little hard to pass. Perhaps that's something we see in the second half of the year. I think for the first half of the year, we're likely to continue to see elevated issuance of taxable municipal bonds.
All right.
Peter, just real quick,
Peter
talking
Hayes?
about that stimulus package, the 1.9 trillion,
Yeah.
I'm curious just to get your thoughts on what's necessary on the state and local level at this point, because that state and local aid is one of the contested parts of that package.
Yeah, I think we've talked about this the last two times you've had me on, and each time the numbers have gotten a bit better. And I'll give you a couple examples. Last April, California was expecting a $54 billion deficit. That's when the economy shut down, worst case scenario. Now they just came out with a $15 billion surplus. The state of Illinois cut their deficit projection from, I think, $5.5 billion to $3 billion. So revenues have been a bit better, meaning, to answer your question, that there's probably a little less need, a little less urgency for a state and local aid package as part of that bigger stimulus package.
Peter Hayes is head of BlackRock's Municipal Bonds Group. We always appreciate your insight into the muni bond market. Thank you for joining us.